Hello, and welcome to Portfolio Matters. As you may know, Richard and I are angel investors, and we met angel investing actually. And we have decided to share our experiences angel investing. And for each company where we get an exit, either successful or unsuccessful, we will tell you the tale, good and bad. Now, we're going to start off with a story of an investment we didn't end up doing, but which took up a lot of time and taught us a lot. And I, in particular, do not come out of this terribly well. But anyway, we learned a lot of lessons. Now, the rule is we are going to disguise the names of all guilty parties. So in all these stories, the company will be run by Charlie and the company will be Charlie's company. So in this case, the company is Charlie's Bars, and the company made snack bars, very good quality health bars of compressed nuts and fruit. Now, I should also, as a double disclaimer, say this story is entirely fictional and any resemblance to real people is entirely coincidental. So don't sue us. Okay, so this was a company called Charlie's Bars, and they made very good quality compressed fruit and nut bars, which were wholly organic and all good things.
So the bars appeal to people with a healthy outlook on life. They're free from gluten, dairy, wheat, soy, refined sugar, palm oil, preservatives, GMOs, genetically modified, I think, whey, isolates, and emulsifiers. So they are suitable for vegans who use raw ingredients, superfoods, sweetened with fruit, not sugar, low GI sugar, high in fiber, high in protein, healthy fats, and chia seeds. And they were jolly nice, I have to say. They were very, very good.
Yes, they were very good. Okay, so to summarize the lessons of this story. Well, number one, don't be both an investor and a friend of the entrepreneur. Frankly, that just doesn't work. At some stage, you have to choose between either being a friend or an investor, because you need to be able to give him firm advice and essentially be able to pull the plug if it's not working and to discipline him. And, you know, it all goes back to Hamlet. Neither a borrower nor a lender be, for loan oft loses both itself and friend, and borrowing dulls the edge of husbandry.
That's very impressive.
Yeah, well, I should have listened to Shakespeare, frankly. And, you know, I invested in this out of a sense of obligation to a friend, and just a bad idea. It doesn't work. And lots of stress and unnecessary and unsuccessful work ensued. The second lesson is that the entrepreneur is key. You know, fundamentally, you have to believe that they're running this business well. Do they have the ambition to grow this business? Are they able to grow and manage this business? Do they have the drive necessary to grow this business and to grow it to a successful exit? Or is this a lifestyle business? And for an angel, the worst possible outcome is a lifestyle business, because you want to get your money back. Even if the company goes bust after a certain amount of time, you can claim loss relief and get a portion of your money back. If you've created a small, moderately successful business that nobody wants to buy and doesn't produce any dividends, then your capital is trapped forever. Lesson 3, crowdfunding, which we will go into, is difficult and expensive. And in this case, The company spent a decent amount of money it could not afford attempting to do a crowdfunding round, and it failed. Fundamentally, the reason why I was skeptical of this company in the first place, even though the bars were good, was that it's a very competitive sector where there's economies of scale and there are very large conglomerates with much greater expertise and deeper pockets who dominate the business, dominate the industry. So in that case, how could a small bar company compete? And finally, if you're in this space, if you're trying to do angel investing, try and create an angel group and listen to them, because different members of the group will have different areas of expertise. And actually, one of the big positives of this experience was actually getting to know Richard better and getting in some other angels with expertise who helped us out, particularly the EIS and corporate strategy specialist, who we will call Michael.
This is shows a different sort of price banding really for these types of bars, and as you can see, there are a lot of them, and there is a big price bracket from the bottom one that's 89p, and to the top one, Cliff Builders, which was £2.59p. So Charlie set his price bracket, his price in the middle of that banding. But as you can see, there's another one at 99p, another one at £2. And so it's quite crowded in that area, but that's where he set it for a 60-gram bar. So that's reasonable. And the retail outlets basically are the specialist whole food outlets and health food outlets. And he was endeavoring to sell abroad through trade fairs.
And I should also say he was delivering the bars to various newsagents and specialist shops in London that he had personally contacted, and he was going around on a bike delivering them in pallets, in packages.
So when we came across him, it was 2017, and his actual forecast revenue for 2017 was 145,000, a gross profit of 57,000, but a loss of 16,000, and selling 6,700 boxes. But his projections were for very rapid growth. I mean, that would be a hockey stick, I think, if you put it on a graph, and moving rapidly into a high level of profitability, EBITDA of 25% in 2021. Obviously, this was pre-COVID, so we don't know what effect COVID would have had on it. So clearly, he was projecting fast growth, a market that was eager to purchase his bars. And the interesting thing is the gross profit level is approximately 50%.
I first came across Charlie's bars at a pitch event, and he was aiming to raise 250 grand via an EIS investment. And the investment was going to be used to outsource production and close the Hoxton kitchen. So he was actually making the bars himself in Hoxton. And obviously that was small and very inefficient, and he was losing money on the production he had. And if he wanted to scale up, then he'd had to get bigger premises, etc. It was much more efficient to outsource. And actually, that was one of the key points of the round, that he was going to outsource everything and lower his cost of production. He was also going to spend money on marketing, on new products, including white label. Now, there are a lot of companies that want their own brand of, health bars, and he'd been approached at trade fairs to do this. And as you will see, he went on to produce some bars for other people. but we'll get into that story later. And also he wanted to introduce biopackaging, which was expensive. So the valuation was, very low, 750 grand pre-money, post-money valuation of 1 million. So before we go on, why do we do angel investing? Well, we do it because of the tax relief. Now, this investment was EIS, which is Enterprise Investment Scheme. And for every £100 that you put in to an EIS investment, 30% comes out of your tax bill. So net effect is it only costs you 70. The government essentially puts in the other 30. But you have to hold it for a minimum of 3 years to keep the tax benefits. You can put in up to £1 million a year. And on exit, you pay no CGT. You can also, if you put in £100, that £100 can be from capital gain. So it can be thought of as rolling over a capital gain. So you don't pay any capital gains on the £100 you put in if you have eligible gains. You can also, if you were to die, and this is not something we want to contemplate, it is there's no inheritance tax. And finally, if it goes bust, you can claim loss relief to get a little bit of your money back. So in the table at the bottom right here shows you the net effect of those tax reliefs. If you are interested, please pause the video and have a look. Okay, so when I first saw this company, I said no. I didn't want to invest because essentially he then didn't have a margin. It's a very competitive sector, and essentially it's dominated by some big companies that have economies of scale, and really you need to be able to buy the ingredients in bulk to lower your costs of production. So those are all very good reasons for avoiding getting involved. But the bars were great. He had an existing set of investors from an accounting firm that we will call AABB, and they'd been with the company for a while and had done multiple rounds and were supportive and actually were experienced angels. So that was quite reassuring having them on board. But above all, at this investor event, Charlie recognized me, and it turned out we went to school together and I remembered him. And suddenly I felt like I should get involved and I should be supportive. And
a sense of obligation.
Precisely. And frankly, I dragged Richard in.
So why we should not have been interested. So when we first met, I wasn't interested, and but slowly and surely, Keith lured me into this opportunity, and at some point, I moved from being not interested to actually putting quite a lot of effort into ensuring we could make a successful investment. So we should not have been interested because it's a highly competitive market where the incumbents do have huge price and marketing advantage, and they have an economy of scale advantage, as Keith said, in terms of their purchasing power. There is very limited pricing power, especially when you're a small niche bar like that, and there's a high turnover of brands. I think we all see these brands that come into the confectioners on the aisle next to the checkouts at M&S and supermarkets, and then another one is there 3 months later, and clearly there's nothing defensible in the IP. Anyone can put a bar together. Whether it tastes nice is a different matter, but there is no moat that you can build around this business. And of course, the last reason we shouldn't have considered it really was that Keith went to school with Charlie.
Yes. Okay, so we came to the first funding round, which was with an angel investment fundraising specialist, which we will call Angel Funds, and they were putting out Charlie's Bars to their network of angel investors, and that is how I came across the company, and I got involved in the fundraising, which ultimately failed, and it failed for all the reasons we have enumerated, that essentially there's just no pricing power. We should have listened as well.
So having failed the first, having failed to raise funding in the first attempt, we collectively decided that a Crowdcube round would be a good idea. And we also had contact with Michael, who worked for this EIS investment round specialist company, who worked for this specialist EIS investment company. And he was also interested in putting it out to his investors separately to Crowdcube. So we had a couple of paths down which we could move to try and raise funding for Charlie's Bars. So this is a screenshot of various companies that are trying to raise money on Crowdcube. And if you don't know the Crowdcube website, it's quite interesting to go and have a look at it. I think you probably have to sign up, but there's no implication to signing up other than that you can see what the various companies who are listed there are looking for. But they charge a fee of 6.6%, so it's not cheap. And then they also charge a completion fee of between 0.75 and 1.25% of all funds raised. And that has VAT on it, which a lot of small companies aren't VAT registered and wouldn't be able to recover. And the chances of success, it maximizes them because it exposes to a large number of potential investors. They like to take on investments where a large chunk of the investment has already been raised, which minimizes the amount that needs to come through Crowdcube, although they do take the full fees on what's already been raised, or endeavor to do so. And they want you to have a good promotional video to show off the company to best effect to potential investors. So because they like companies to come with a decent amount of the round already committed, the effective fee on the amount raised through Crowdcube can become quite high. For example, if you are raising 100,000 and you arrive on the platform with 50,000 committed, the fee that they would charge would be 6.6% of the 100,000 plus the commitment fee, the completion fee. And so, in fact, by raising £50,000 on the platform, your fee could be 10 to 15%, depending on the calculation, the precise nature of the calculation. So it can be very expensive.
But the other avenue we could go down was to go via this EIS specific round in a company that had an EIS fund, and Charlie's Bars would go into that fund. Now, in order for Charlie's Bars to be eligible for inclusion in the fund, then various things needed to happen. Above all, it needed to have a proper corporate structure. So it needed to have a chairman, a formal separation between non-executive and executive directors, and a majority non-executive directors. Now, bearing in mind, currently the board of directors, the chairman and CEO, were all Charlie. So you needed to put in proper governance. You also needed to put in a CFO, even if it was only 1 day a week. You also had to purchase directors and officers, insurance, etc., etc. Now, Michael was a friend of the AABB angel investors who had put in a lot of money so far supporting Charlie. And he was involved with Charlie's Bars also through a sense of obligation to his colleagues. And he put in a lot of time and effort describing what Charlie's Bars needed to do and also setting up the EIS round?
Things started to go wrong, really, with the video for CrowdQ. So the company, as with many small companies, didn't have very much money. It had 20K. And Charlie has had some experience as a film director. So he was very keen to ensure that the film was of a high quality film. And he had a friend who could do it at a special rate. We considered that really spending very much money at all on a video wasn't sensible, and that it would be quite easy to make one for basically very little indeed if it was well staged, and like a few £100 probably, and that he should conserve his money. But Charlie insisted that the best way of enticing investors to invest in the company was to have a high quality video. And we had no choice, clearly. So that's what happened. Charlie's mate initially said that he could do it for the price that was quoted. But halfway through the process, he said he could no longer do it at the price quoted. He needed more money, and stopped working on the video, which delayed the video and obviously delayed the funding round, because the funding round couldn't commence without the video. So ultimately, 15K of the 20K, 3/4 of the available funds for the business, was spent on a 2-minute video. It was an excellent video, and which included £1,000 on the voiceover. And the CrowdCube round failed. And clearly the company has left very little money, but a very good video.
Then, so the CrowdQ round has failed. So we're then really left with only one option, which is to go through this EIS round. But although Michael was making very clear what Charlie needed to do to reform the governance of the company, Charlie would say he was going to do it, then do nothing at all. And so Michael was becoming increasingly concerned and frustrated, and he was giving a lot of his time for free. And while this was going on, time was dragging, and we were all beginning to become concerned in Charlie's management of the company and whether actually he could do this. And in particular, I was becoming concerned by the way that he was interacting with me, because he was saying things like, I know that I can trust you, Keith. And I knew immediately that you were somebody I could trust, Keith. And it became apparent to me that Charlie's core skill was not actually running this business, because frankly, the business did not seem to be run well. His core skill was actually emotionally blackmailing people to invest in his company. And so he had managed to get the AABB people to participate in multiple rounds, and he'd managed to drag me in, and I'd dragged various other people in out of a sense of obligation and goodwill. But once I'd had that thought, it was difficult to erase it from my mind.
So I actually did quite a lot of work on calculating the break-even cost of production with all of the materials that he was putting. He was starting to outsource the manufacturing to a company, and so I put in this work to provide Charlie with the break-even price. In other words, the price which he couldn't sell below, and not make a gross profit. And I was completely dismayed when he announced that he had sold half a pallet of bars to Germany. And when I asked what price he'd sold them at, it was below his break-even price. In other words, he'd sold them at a gross loss. And for me, that really made me question whether Charlie had the business acumen to be able to take this forward.
So ultimately, Michael, Richard, and I talked, and we came up with an ultimatum. He had to instigate the corporate governance changes that Michael required to do the EIS round, or there was going to be no funding round and the company would fail. So I, having got Richard and Michael into this mess, was tasked with calling him and delivering the ultimatum. And when I had that call with him, he immediately burst into tears on the phone and started maligning Michael and telling me that, you shouldn't be calling me, Keith. You should be on my side. You should be on my side against Michael. And frankly, this whole thing that conversation made me very angry, because I was trying to have a professional conversation with him about perfectly reasonable requests that he changes the company to ensure its survival. And instead, he burst into tears. And it became clear to me that, if this is what the relationship was like now, then if I went ahead with this, then every difficult conversation would end up with him essentially attempting to emotionally blackmail me round to his side. And so Richard, Michael, and I then had a conversation. I called him up the next day, and we withdrew our funding. And frankly, that is pretty much the last time I ever talked to him.
So the Crowdcube round had failed, the EIS round was pulled, and sadly, Charlie's bars dissolved in July 2021. And it is sad because the product was very good. And it's a shame when a business struggles and fails. And it's a shame when someone puts so much of their life and their personal resources into a business and it fails. So I think Keith and I both feel very sad about it. But there is more to running a small entrepreneurial business than having the idea. You do have to have the business acumen to make it work.
Absolutely. So, the bottom line is, it's a very, very sad story, really. But I shouldn't have got involved, and I shouldn't have got Richard involved. And actually, the big thing it taught me was, if you ever come to invest in a business where the entrepreneur and where you have a relationship with them, you have to choose. You can either be an investor or a friend. You can't be both. And if you do choose to invest, you have to basically stand back and not get involved in the business and forget about it, and have your relationship able to survive the loss of the business and the loss of all your money. If that's not acceptable, don't get involved. The other thing I learned is Crowdcube. Crowdcube is just amazingly expensive, and difficult. And for small companies, unless you already have a large amount of the raise pre-funded, then it doesn't work. And the costs of producing a video, etc., are not trivial. But the one positive was that, Richard, Michael, and I actually did quite a lot of work together, and that, was interesting, and I think brought us together. So, in summary, angel investing, it can work, but it takes a lot of time, and you will see a lot of small failing companies, and the job is to try and sort out the ones with a modest chance of success. Richard, your final thoughts?
Well, exactly, Keith. It is. It's very difficult to look into the future and work out whether a business is going to be successful. And I think the single most defining character, and a lot of people say this, is the quality of the owner, of the founder, and that whether their level of incisiveness and understanding of how to run a business as well as their idea.
Precisely. Okay, so thank you all for watching. Angel investing is quite opaque, and it's very difficult to find out actually how other people have done, what they've done, and to learn lessons from other people's experience. So our recording these videos of our investments is, the aim is to try and share our experiences, and we would really enjoy other people coming onto the channel to share their experiences as well. And we will be producing a separate playlist of angel investment podcasts, of which this one will be the first. So if you have an angel investment story that you'd like to share, please get in touch. In the meantime, please can you press like and subscribe to the channel, and it's goodbye from Richard Wheater.
And it's goodbye from Keith Jordan. Goodbye.
Goodbye.
Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information, nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.